Gentlemen, I'm Aftab Patel, Chief Executive Officer of Omaniya Financial Services. It's my pleasure to welcome you all to this presentation and to the MSX discussion session. We'll take you through briefly the company information, including the published results. Including the published results. Once we are through, then there will be a fair amount of time where we'll be pleased to take any questions, queries, clarifications that you may have. And thank you very much for being here. Take on to the next slide, please. So this is briefly the agenda, what we are going to be telling you, starting with a brief introduction and finally taking you through to the question and answer session. As you all know, we have been licensed by under the Banking Regulation Act. Our primary regulator is Central Bank of Oman, and we're licensed to carry on the business of a non-financial banking, non-financial financial institution. And we almost provide a very comprehensive suite of financial products, both on that long, medium, and short-term end of the market. We both have a substantial retail as well as a large corporate portfolio. The company was formed with the initial capital of 3 million, and the 60% of the capital came from the shareholders of Bank Muscat, and 40% we went public as required by the Companies Commercial Act of Oman. And we are very fortunate that our initial public offer was oversubscribed by 4,300% or 43 times. Having said that, we have a very esteemed board of directors here. We have been very fortunate that they have been with us almost for the entire life of this company. Our board is headed by eminent Sheikh Khalid Al-Wahibi, who has been the chairman almost since the inception. And then we have Sheikh Khalid Al-Mashni, who also is in the board of several financial institutions, including Bank Muscat. And then we have Sheikh Zaki Hassan Al-Nasib, who is also the chairman of the audit committee, who brings a lot of his experience. And then we have Mr. Nabil Al-Mahrouki, who represents who is an independent director and who brings with him a lot of experience in investment, as well as in management. And then we have Mr. Ibrahim Al-Wahibi, who has been a long-standing member and with the company for more than 2 decades. Similarly, we have Sheikh Tariq Al-Mashni and Mr. Shikhar Dharamsi. We have also Mr. Imad. And then finally, we have Sheikh Awad Salim Al-Mustail Al-Mashni. Okay. So on the management side, we have fortunate to have a group of people, a group of very committed people. There's a management team. On this table, we probably represent at least about 150 years of experience. My team here has been with us for more than 2 decades. And they've been, I'll just say briefly, the team will say hello to you. So I have here on my right, Lata Ramakrishnan, who is our General Manager, Risk Management, who has been with the company for
27 years.
27 years. Welcome to the meeting, Lata.
Yeah, thank you. I think I'm really saying a very good evening to you all and welcome to the meeting.
And then we have Samia Al-Hasni, our very proud to have her, our HR manager.
Hi.
Who's been with the company for
17 years.
17 years. And then we have Mr. Manish Bhaskar, who heads our IT. And then we have the board secretary, Mr. Chandrasekhar.
Hello, sir. Hello.
And we have Mrs. Prema Shukmar, who heads our retail lifestyle product. And
Hello.
Mr. Ram Kumar, Chief Manager for our car and SMEs. We have Mr. Vichu Varghese. He's the head of our corporate portfolio. And then we have Mr. Chandrasekhar, our Chief Manager Finance. And we have Mr. Salim Awadi, who's online, who's our Deputy CEO, who's joined us online. Welcome.
Hello, everybody. Good evening.
Welcome, all of you. And I think now let's move on to the next.
Yes.
Management, then we'll take you briefly, gentlemen, to our products. We offer products across various segments. I mean, basically, we are both into the corporate loans. They include working capital loans, asset loans for plant, machinery, transport equipment, commercial vehicles. We do bill discounting, debt factoring, project finance, bridge loans, construction loans to warehouses and factories. And we also accept fixed deposits from the corporate as rules framed by the Central Bank of Oman, our regulator. And we have also retail products, especially the lifestyle loans, which is a higher purchase product for acquiring white and brown goods. And on the retail side, we also have a substantial car loan portfolio. Now, basically, on the corporate side, we generally deal with large corporates. And our endeavor has always been to look at prime and prime plus customer segmentation, which we believe is our one of the highlights of how Omaniya's business model is framed. Now, coming to a little bit to the highlights, we are a premier market leader in several segments. Overall, we are not the largest, but we have in the prime and prime plus category in certain classes of business, like collaborating with the banks for syndication financing is an area that probably we're the only NBFC into that segment, which we have done a lot of syndication with our partner banks like Bank Muscat, National Bank of Oman, Bank Sohar, etc. And we continue to focus on that as one of our strategy to move. Then, as you all know, our client base is now currently more than 100,000. We have a very consistent and a steady growth track record. We haven't grown by leaps and bounds, but we have grown in line with the GDP and sometimes even higher than that. We're very proud of the fact that Omaniya has paid dividend every single year of its existence, right from inception till 2025. And we're also proud of the fact that even during the COVID years, we managed to retain our business, retain our people, and also managed to pay a cash dividend. So, gentlemen, our asset quality is good. Our provisioning cover is very robust. Our capital structure is good. Our liquidity position is very high. And our NPL is one of the lowest in the industry, both across banking and non-banking segment. Now, let's go on to the next slide of the dividend payment. Gentlemen, if you see, from 1998 till 2025, we have been very, very blessed, proud to have a performance and have paid a dividend and a cash dividend every single year. It's not, and our total dividend payment is now in excess of 500% for the last few years, and that's a track record that we're really proud of. Both it shows our consistency and our commitment. Now, let's very quickly move on to the. We won't spend a lot of time here. All of you are already familiar with this. We'll talk a little bit about the Oman's fiscal performance or the budget numbers and the deficit and how things have moved on. And here it is right in front of you, gentlemen. Our projected revenue, I think, was budget estimates showed a deficit of 620 million Omani riyals. We actually ended up with just under $500 million, 480, and our spending was higher by 4%. Revenue growth was up by about 5%. I think the estimates of the oil price was about 60, and we actually realized about 70. So we won't go too much into the details. You're already familiar with most of these things, right? And broadly, next one, yeah. Here we can also see that 2021, if you look at the actual numbers, a deficit of 1.2 billion Omani riyals, which then translated into actually a surplus of 1.14 billion in the year 2022 against a projected deficit of 1.6. Then 2023 against a projected deficit of 605 million, we almost had 1 billion surplus, and thereafter we ran a surplus of about $500 million. 2025, it was a deficit of 400 million. And the government of Oman has been extremely cautious, prudent, and they have paid down the debt, bringing down our debt as a percent of GDP to a very nominal level to considering what we had in the earlier few years. And that augurs extremely well, right? And here we have the financial framework, total spending. Also, we have seen a growth from 26, 27, 28. Projections are good. Okay. General budget, this is a repeat.
26 budget.
26 budget. I think on the 26 budget takes into account the Oman Vision 2040, building a sustainable and a diverse economy has been one of the hallmarks of the government policies. And I think that it continues to augur very well. Right, and we expect that our revenues will be much higher, and then we'll also expect that we'll be able to report a substantial surplus in the budget 2026. Here we have our ratings, which are back into 2023. No, BB plus, triple B. BA1, so we're back into the investment grade rating now, which augurs well for any debt that we want to raise. Both Moody's and S&P and Fitch, I think the ratings have been in line and with a stable outlook by all the three international ratings. So both we will be benefiting from what the Vision 240 is, what is government proposing to achieve, the government spending, the development expenditure, as well as we will be subject to the generic risk of the volatility in oil prices, the geopolitical things that can arise. So we will be subject to those risks as well, which we believe, I personally believe, those are very low very, very low risk, and we will continue to see a very stable and a growth environment going towards 2026, in spite of what we have seen in the region. I think, gentlemen, will now come to our financial performance. We have here for you financial statements going to from 2020 to 2025. I believe most of my informed audience here, they would have had the opportunity to run through all this. They have been published, and they're also available on the Muscat Securities Market website. Now, as you've seen now, from 2020 to 2025, we have seen a reasonable amount of growth. 2020 was the COVID year. So post that, our growth has always been from 1.4 million to almost about 80% growth. Thereafter, we've seen a growth of a net profit between 10 to 12%. And we continue to focus on our growth, maintaining the asset quality, maintaining a robust provision, a very robust capital structure. That will be some of the objectives that we aim to achieve going forward. Now, 2020, if you look at the statistics, our gross hire purchase assets was about 114 million Omani riyals, which are now currently at 147. So if you look at it, growth, it is almost like about in a 5-year period, it grew 35 to 40%, from 114 to 147. How much that comes to? 147 divided by 114? 29 to 30% for a period of 5 years. So it's a compounded growth about 5.5%. And in the same way, I think our provisions also have grown from 9 million to about 15 million now. Estimated total assets have grown from about 181 million to currently 225 million Omani riyals. Net borrowings have marginally grown in line with our growth in the asset size. Our debt equity continues to be extremely low, showing a very high potential for growth. So if there are any growth opportunities, we will capitalize on those growth opportunities. We will not be constrained by lack of resources or banking facilities. So we have enough liquidity to capitalize on whatever opportunities that come our way, so long they fit into our credit quality. And I think ECM, expected credit losses provision, currently stands at 10.3. And in the last 4 years, dividend, 2020 was a COVID year, was an anomaly where the dividend was still paid, 4% cash. Then we raised it by 300% in the very next year. And last year, our dividend to 2025, gentlemen, has already been paid and credited to the shareholders' account for 16%, which is approximately about 4.9 million Omani riyals. So we'll take you a little bit more into the 2025, our audited accounts. So we had a unqualified clean audit report. It's duly been published both in the newspapers as well as on the MSX. Our auditors were Ernst & Young, among the top 4 in Oman. And for 2026, the board of directors and the shareholders have approved their appointment, and they will continue to be our audit for the year 2026. Now, our comprehensive income, if you have a look at it, 25 as compared to 2024, because there was a fall in the rates, overall, both the interest cost as well as the lending rates fell. And so our income almost remained constant at 15 million Omani riyals. The interest expense was down by almost 600,000. which is about 10%. And as a result of which the net income grew by 6.65%. Our other income fell. That was mainly because we are increasingly writing off less and less, as a result of which our rate of collection is also declining. Operating expenses were by and large steady. There was a marginal increase. Provision for expected credit losses were not required as per our model and as per the regulators, as well as per our auditors. We didn't. We were required to write back 305,000, which is substantially surplus. Depreciation, of course, and therefore we arrived at a net profit of 4,619,000, and after the income tax of 661,953, we have achieved a net profit of 3,957,000, say 4 million, which is a 10% growth over the last year. We continue to have now, yes, this other comprehensive income is not too, it is just the book entries here about the forward cover charges for the foreign currency loans. So this will get compensated in the next report. Having a look at the balance sheet here, we continue to have robust cash balances of 90 million. And I would like to come back to this cash balances a little later after we go. A lot of you will have questions on why we are holding this cash. So net investment in finance leases was 132 million after deducting the provisions. And as a result of which, our total assets are 225 million Omani riyals. On the liability side, there has not been a substantial change, excepting that the borrowings have marginally gone up to reflect the increase in our portfolio. Our net investment in the loans, deposits are constant, almost a million increase. Term loans are same. We have compulsory convertible bonds, which were issued in the previous years. And then the non-convertible bonds issued to the shareholders. Both these bonds have been issued without consideration as part of the dividend to the shareholders. And the non-convertible bonds will be redeemed in cash on the due date. Other liabilities, then the current tax payable, deferred tax liability. So total liability is 158 million. From the equity side, there's not much changes. We continue to have a paid up capital of 31.5 million, same as the last year. Share premium account is same. Legal reserve, we have reached the maximum required for legal reserve, therefore there is no change. You need to have 33% of your paid up capital as a legal reserve. Thereafter, there is no obligation to make any further legal reserve. So the special reserve for non-performing assets, as a matter of abundant precaution, continues to appear in our books. Cash flow hedge is 198. That's because of the forward cover on our dollar-based loans. The retained earnings are marginally lower. That's because it reflects the dividend paid in March of last year. Similarly, the net asset value is 213 Beja. Now, gentlemen, I want to come back a little bit to our cash position or cash and deposit position. Like, I'm sure a lot of people, a lot of you may have questioned on why we continue to hold this level of deposits. Our deposits remain unchanged at about 85 million. Yeah. Yes, our deposits remain at 90 million. Now, these deposits have been leveraged properly. We are able to, the primary reason why we continue to hold this deposit is as and when we believe there is a substantial growth, or as and when we see the opportunities that arise in the marketplace, which fit into our credit criteria, we will be in a position to capitalize those opportunities, those lending opportunities, and increase our asset size. So that's the very primary reason why we continue to hold on. But while we are holding on to them, they are not coming at a net cost to the company. We are able to leverage them properly, and as a result of which, we have one of the lowest cost borrowing as compared to our peers. There's at least a benefit of about 100 to 125 basis points in our borrowing cost net, as well as this we are able to leverage this properly and increase our income. So that's the primary purpose. And in spite of the deposits that we hold, we continue to have banking facilities available to us, which are not utilized fully. That means there is a gap. Apart from this 90 million, we will have another 20 million in banking facilities. So that comes to almost 110 million. 80. So 80 million, sorry, my mistake. 80 million. So that comes to about 170 million. So that is the position why we continue to have. I hope it answers some of your doubts. Here is a very brief, we don't want to get into a kind of a comparison. These are the numbers from the published figures. They will help you to understand Omaniya's performance, Omaniya's business model vis-a-vis our peers and who are in this, right? We have a total of 5 non-banking financial institutions, Oman. All of them are very well capitalized and they have a long standing. But some of the fundamental figures we are presenting to you. The top line here will shows you the size of the assets. So in asset size, we are number 3. We are ranked number 3. Non-performing loans, as usual, we are the lowest and lowest by far. Both. If you look at the non-performing loan as a percentage of our assets, which is, I think, one of the best measures to see what kind of quality, what quality of credit do you really write? What is the, whether you are into prime or subprime or prime plus category is reflected in what is the percentage of the loans that have become non-performing cumulatively. Our cumulative non-performing loans are 2.58% as compared to some of our peers, 31%, 12%, 12%, 21%. I think the industry average would probably come to about
60 to 70%.
31, 50, 60, 70 by 4, about 18.5 to 19%. Compared to that, we are 2.5%. Our provision cover is 539% as compared to the lowest in industry, 62%. Now, the reason why we continue to maintain this high level of provisioning is simply because we are also in a large capital and large corporates, and we do a bit of syndication, and we believe that to keep look at what's happening in the future, and that's a risk that we want to provide for, however remote it might be. And this is not really coming out of the provisions made in the current years. This is the provisions that we are carrying forward historically. And therefore, we believe that in the last 1 or 2 years now, especially, they are not really impacting our income statement. In fact, for the year 2025, we had to write back for 300,000 in provision simply because our
requirement.
What is our model?
IFRS.
IFRS model required that we had to write back just to 300. So we continue to be very well provided, very robust, very high liquidity, and as compared to our peers, we are way below in terms of the NPLs. Now, in terms of our prognosis, we believe that we'll continue to outperform the growth in the GDP. That's our stated objective, and hoping that the growth in the economy will be substantial. It looks very, for the time being, it looks very encouraging. Oil prices are much higher than what the budget estimates of $80 now. I think the surplus is also expected to be higher. We also have seen a much larger allocation for the development expenditure. Government is continuing to focus on diversifying the economy and the GDP away from the oil and gas sector, including alternate energy. I think we are doing a fantastic progress on the hydrogen fuel, right? And both on the tourism sector, we are, I think, making a lot of progress. Hospitality, these are some of the growth areas that we see. We also see some growth emerging into the healthcare sector, tourism, and so on. So I think we are hopefully, barring a geopolitical situation, I think we are looking forward to a good performance in the year 2026. Gentlemen, we have been given many awards, but there's one single award that stands out that we just like to show it to you. This award is not a really award. This is based on an independent public survey done by Apex Publications. And this is on the basis of the voting in this survey, where the people at large, institutions at large, nominate or vote for the top brand in each category. I'm pleased, I'm proud. Gentlemen, this is the 4th year in a row Omaniya has been voted as the number one, the brand, the most trusted brand in the non-banking financial institution sector. And this is something that, validates what we do. It encourages us to do better and meet up the standards and the expectations that people of Oman and our clients, customers, banks, and the regulators have of Omaniya. We will work very, very hard to ensure that we work with the same transparency, integrity, and to bring about the best possible products to our customers and to set a standard in the corporate governance. Okay, I have finished a little early, gentlemen, to give you almost a little more than half an hour for your question and clarifications, questions, whatever you would like to answer, and whatever we can, we'll certainly be happy to provide you. So I would request you to introduce yourself and also tell us the company or the institution that you represent, and then ask a question. We'll kindly request you to have a commentary, but you can always give a small explanation, rationale behind the question, and we'll be quite happy to take them up. Thank you very much, gentlemen. Please go ahead.
Mr. Saru. Vision Capital.
Yeah. Mr. Saru.
Hi, good evening. Am I audible?
Good evening. Yes, go ahead.
Yes, thank you for the opportunity and thank you for the presentation. I'll start my questions with the growth in your leasing assets during the fourth quarter. Pretty much, whatever growth you showed us from 24 to 25, it was there. It was achieved in the fourth quarter. Your gross investment finance leases went from 155 million to 64 million. So should we be expecting a more aggressive growth in the upcoming quarters, or should we expect the normalized 7 to 10% growth for 2026? Would be my first question.
All right. So, our growth strategy basically is being like what I say as uh, being within the box and not outside the box. And what we mean by that strategy is that we define the parameters or the counters of the kind of credit that we want, the quality of credit we want. And we say that we've got enough resources to write what that quality, which if it presents to ourselves. That's the what we have. So we really will not go by quarter to quarter and not, succumb to the growth pressures and end up writing business which is not very satisfactory. But however, this year, we believe that there will be a consistent growth of 7 to 9% in each quarter. That's what we are aiming at.
I'm sorry, you mentioned 7 to 9% in each quarter. So for the whole year, it would be north of 25%. Is that what
No,
you're
I'm
saying?
saying cumulative. So if we grow on each session cumulatively, we expect a growth of about 10%. Because when you grow by 6, 7%, we compare it to the quarter of the 2025.
Okay, okay. Yes, that makes sense, but that was a little confusing because first quarter of 25 was already way less than, the fourth quarter of 25. So if you were to put 7% on first quarter 25, that would come up actually at a lower number. But okay, I get your point. On an annual basis, it should be that. Now, my second question is, you mentioned that on the cash that you have or the deposit that you have on your balance sheet, it actually, improves your cost of funding. But from what I'm analyzing, this also puts a dent on your overall yields on investments. And as a result, the total return on equity generated on your company is a little bit less than the peers. So wouldn't it be better, because obviously you guys have such a good credit rating and such a good credit standing with the banks? Wouldn't it be better if you were to pay this off, and then whenever you have the chance to grow your book, you can go to any bank, and then no bank would be shy away from giving you a debt? Is my understanding, please?
Really, the
Comment.
strategy here, that when you sit on this kind of liquidity, right, which gives you the ability to pay off any of your lender. Many times we have been independent, some of the large lenders in the country. As a financial institution, if you can be independent of some of the large lenders, that speaks volumes for yourselves. Now, what does this cash really do to us? Number one, that I said, it raises the yield on our equity because it gives us an arbitrage. First of all, if you have made the comparison of the average cost of borrowing and the Omaniya's borrowing, we are about 150 basis points lower than our nearest peer. Now, our current borrowing is about 130, 140 million, right? Now, if you take 1.5% on that itself will amount to over $1 million. Number one. Two, it also gives us some level of arbitrage. So net, we don't lose money on this, but gives us a tremendous amount of strength and the negotiating ability. And I hear a lot from my own peers saying, wish we only could do this, wish we only could do this. But since we have established this and we had the ability to borrow, right? And that's the reason why we'll continue to maintain, because we see a lot of positives coming from this strategy. And like I said, sorry, I didn't get your name, Mr.
Shaur. It's Shaur, sir.
Shaur. Like I said, in spite of this 90 million, we still have 80 million in unutilized banking facilities. So having this cash is not constraining our ability to write more business. Now imagine if there are opportunities, and it's not only that, it gives you an opportunity for both what you call organic as well as inorganic growth. So you never know when the opportunities will arise. So actually that gives us about 90 plus 80, 170 million, if we really want to go out and find the right kind of businesses.
Okay.
Hope
Thank
I'm
you.
clear. Okay.
Yes. And my last question, if you allow,
Sure, go
my
ahead, go
last
ahead.
question is that on your asset side, on the yield of your leasing assets, we have seen that Omaniya, because of such high quality assets that you guys have, your yield is a little bit lower than the peers as well. Now I'm
Correct.
assuming that because risky assets require high yields and lower risk requires a lower yield. With this growth plan that you have in mind of 7 to 9%, should we be expecting an increase in the yield on your leasing assets as well?
What we, I mean, this, so I just want you to know one more thing. Let's say now, as compared to our peers, I completely agree with you that our yields are lower, right? But then, if our yields are lower, we continue to pay one of the highest dividends in the country. Now, excepting for, say, this year, when one of the peers paid a little higher, look at the track record. Now, if you look at the 5 companies, what is leave out Omaniya, what is the average dividend paid? So I'll tell you, dividend and profitability is not necessarily a function of at what rate you lend, because that's not your real income. You can go out in the market and lend, but then if you need a substantial provision, that cuts out your income. 1. 2, you will be aware that the regulators for financial institution require that you need their permission when you declare the dividend. And that is a standard policy that if your provisioning level is less than 100% and it is not a net negative, then you are not allowed generally to pay a dividend of more than 60% of your profits. Now, does that make sense to you that we consistently pay out a 90% ratio on our cash? Now, if your provisioning level, we just some time ago presented to you what was the NPL and provisioning level of the peers. None of them have 100%. Now, so you declare a higher profit, but you're not in line with provisioning to declare 80 or 90% profit. That means you're paying a much higher charges and you're not able to pay out to the shareholders. So unless the profit translates into a dividend or real retained earnings, not accounting retained earnings, then it doesn't make sense. So what we're saying is that in spite of the low yields that we have, which I agree with you, that will not allow that to impact what we pay out to our shareholders.
Okay.
All right.
Yes. Thank you. That makes sense. Thank you.
Yes, gentlemen. Please, anybody else has a question?
Hello, hi, can you hear me?
Yes, go ahead.
My name is Omaniya and I am analyst at Umar Capital. I have a couple of questions. My first question is that Shaw rightly mentioned that your yield is low compared to peers. Can you please give us what is the yield on the working capital and retail portion and uh, the corporate?
Sorry, you're not very clear. Can you be a little loud?
Can you give us the breakup on what are the yield on the retail on working capital?
Okay, you know what? Most of the, on an average, we can tell you that our yields on the retail, which is our car loan and the white good portfolio, will be in the range of about
9
to 10.5% IRR. All right. Hello, Mr. Rao, Amir Ali.
Yes.
Am I audible?
Thank-
Okay.
Yes.
So on the retail portfolio, which is basically the car loans that we have and the white goods that we have, the average yield is between 9.5 to 10.5 IRR, not the flat. Okay. Now, as for the
Okay.
corporates go, the corporate lending is a function of the yes. So the corporate lending is a function of many things. It depends upon the client's ability to negotiate. It depends upon what kind of facilities it has. It depends upon what kind of securities they offer. And primarily, it also depends upon what is the lending tenor. See, we are at the every end of the lending segment. That means we lend from 90 days to 12 years. The syndicated loans may go for 12 years, 10 years, and some of our working capital facilities may be just for 90 days. So there will be a wide variation in the rates. So I'm not able to actually tell you what exactly rates, because it differs from client to client. And as I told you, we deal with very large, very large corporates, very large family businesses, and we deal with very large listed companies. And those rates will be in line with what the commercial banks lend. We are not in competition on this segment with our other finance companies. We are in competition with the banks. And since we have the ability to borrow low and keep our cost of funds low, therefore we have developed this ability to able to compete in this particular segment and have a market share in that.
Thank you for the detailed answer. I have one more question. You have booked impairment reversal during 2025, and even in 2024, the impairment cost was low, around 558 million, compared to 2.1 million in 2023, 0.5 million. So what are the reasons for reversals, and can we see the same trend in 2026?
Yeah. So your question is,
Created a portion for 48, they reversed in 26.
correct. You see, the provision is basically a function of the model, IFRS model that we have. Each of these models are what you call evaluated by some of these large audit firms, right? Every few years, and this also have to be in principle. Your regulator has to be happy with that. Now, many times, Mr. Rao, what happens is that, say for example, even the model require that we take into account both the micro and the macroeconomics, both within the client's business segment, within his own business, as well as the external environment, right? For example, say the oil prices are low or deficit goes up, right? Then suddenly what happens is that in the model, we have to give slightly lower rating, which increases the provision. Similarly, in a particular industry, say oil and gas industry, for example, if the oil prices were to fall below a particular level, then automatically our weightage that we have to attach for those segments of the industry will be slightly higher. So even if a micro unit is doing quite well, has no payment problem, there is no default, but in spite of that, if the industry as a whole at the macro level is according to whatever what you call the IFRS model, that the weights that have been attached, so the provision can go up. So what happens is sometimes this is a very technical matter. It's not necessarily related to an actual default. Actual default obviously will carry the provision. Sometimes even if you don't have a default, right? And even in such cases, a particular client falls into a particular industry segment which has got a lower rating because of macroeconomic factors, then the provision goes up. So that's how the whole IFRS model built. And generally, as Omaniya, we would rather err on the side of caution than be aggressive. I hope that answers your question.
Thank you. Thank you.
You're welcome. Good, gentlemen, we still have some time and we will be happy to answer if you have any questions. Okay, gentlemen, I think we have another 2 minutes. Thank you very each one of you and for engaging us with this in this session. We are delighted that all of you participated in this. It was a robust question and answer session. I hope our presentation was useful to you. And in case you have any queries, we are always open. Our information is available on the website, as well as it is available on the MSX website. And thank you very much. And I hope you have a very pleasant evening. Thank you.